We'll just wait for a couple of minutes for everyone to join in and then start the webinar.
Hello. Hi, Ankita.
Hello, hi Mathew.
Should we wait for a few more? I think we have about 50 people in the audience. Should we wait for another 2-3 minutes for a few more, or should we get started?
I think we can get started in another 2 minutes. Let's just give it 4 minutes.
Perfect. All right, I think we can get started. Good afternoon, everyone. I'm dialing in from a very, very wet Delhi, where I was here on a lightning visit. So forgive me if the network is patchy. But welcome to our session on default loss guarantees. Quick introduction. I'm a tech lawyer with about 21 years of experience. And I have with me on the panel Ankita, who is a financial sector regulatory lawyer with about slightly less than 10 years these days, I think. Growing old, Ankita. But anyway, between Ankita and me, we've figured out some of the more controversial fintech solutions that have dogged India in the last 5-6 months. Most of it has worked out to have the regulators' approval, but we'll take you through what we feel, and because we work with the regulators so often, we'll take you through what we feel the regulator wants in terms of default loss guarantees. We'll also take you through what we feel the regulator doesn't want with regard to default loss guarantees. For example, we've got hours and hours of debate, including today morning, with one of India's leading fintechs on whether credit card-based lending, EMI structures are captured through default loss guarantees. So in the course of this discussion, we'll take you through all of those. As always, we live and breathe a lot of what we talk about. So we're not very keen on this being a monologue. If any of you want to interrupt us, please do. If any of you want to, ask questions, please don't raise your hand. Just jump up and ask that question, just like we would if we were in some kind of a table discussing this topic. With that said, shall we move on to the next slide, Ishita? And can we skip over the normal marketing slides that I know you put in there, which says that we're God's gift to financial services? Yes, perfect. This is what we hope to cover. We'll take you through the Reserve Bank's policies on risk sharing. We'll track the legal developments. We'll go from day one all the way down to today. We'll look at applicability of the guidelines, the DLG guidelines. We'll look at what DLG is, and we'll also look at some live We'll look at live examples of how this has worked out. We'll look at how guarantees have played a role in the financial sector, fintech boom in India, and what the Reserve Bank thinks of those, and what the Reserve Bank does not want you to do. And we'll go through a lot of, I hope we can cover this. If we can't, we'll do another follow-on. But we'll also look at co-lending and risk-sharing models. We'll look at structuring DLG arrangements. We'll look at the compliance burden that the new obligations place through. And also, what are the fancy contractual arrangements that are in vogue now, TSPs, embedded solutions, and all of that within digital line. So with that said, let's move on to a slightly more substantive treatment. I'm aware we have very limited time. Given that I'm in not the best network zone, Ankita, do you want to take this over?
Sure, Mathew. So before we kind of jump into the default loss guarantee guidelines as of today that apply to digital lending, let's quickly look at what are the risk sharing arrangements and why do lenders even enter into arrangements of this sort. Fundamental issue is that lending poses several risks. There is credit management, there is rebalancing exposures, there are strategic decisions that lenders need to take with respect to the credit on their books. All of this results in evaluating different risk sharing models. Some, of course, some are permitted, some are not, some are regulated, some have a higher threshold of compliance and regulations. The common structures typically adopted, of course, there is synthetic securitization that we've heard and discussed a lot with the last few guidelines that have come in from the RBI, especially with respect to digital lending. There's loan participation arrangements. You have the formal securitization process under the securitization guidelines. You have transfer of loan exposures under the specific RBI guidelines. And there are, of course, other forms of guarantees and indemnities, reps and warranties, liquidated damages structures that are included under different contractual arrangements to try and mitigate different risks in an arrangement of this sort. With the share that digital lending took up in the market in the last few years, of course, there was a need to bring in some sort of regulatory mechanisms in how a lending service provider operated with a regulated entity when it came to risk sharing. given that most of these players were doing 100% guarantees in every form, which ultimately led to RBI taking a stance on the default loss sharing arrangements. Before we kind of deep dive into this particular definition and see what it actually covers, let's take a quick look at how we've arrived at the existing regulation. It all started off with the working group committee that was set up by the RBI way back in Jan 2021. The idea was that they're going to evaluate the lending practices currently that were being followed in the sector at that point of time. There was a clear indication that the RBI felt that there was a systemic risk and implications with respect to the different practices that were being followed. There was, of course, no specific intent to look at FLDG, but as a part of how all these arrangements operated, FLDG came out to be an important factor that had to be evaluated. That can be dealt, that was then further on dealt in the report that the working group had issued in November. It highlighted the concerns with respect to rent and NBFC, shadow lending, off-balance sheet lending, fringe lenders, all of those aspects. It also focused on the significantly high interest rates that were being charged because of the lending arrangements and the revenue, the risk participation mechanisms that were being put in place. Then there was a press release with the recommendations. The recommendations merely indicated that FLDG in the form of synthetic securitization should not be undertaken. It referred to the securitization guidelines, and so did the guidelines on digital lending ultimately that were issued in September. This, of course, created a lot of noise. Positions weren't clear on whether this is permitted, it's prohibited. It merely said comply with securitization guidelines. Then, of course, there were FAQs, which I'm sure a lot of people had a lot of hope with, that the FAQs would bring clarity on the FLDG arrangements. But soon we had the guidelines that were issued in June, the default loss guarantees. It's interesting to note that the guidelines actually refer to default loss guarantees and not really first loss or second loss, which is an important aspect to consider evaluating what these guarantee arrangements are. Let's take a quick look at applicability. Who all does it apply to? From a regulated entity's perspective, all your commercial banks, including small finance banks, your cooperative banks, state cooperatives, central cooperatives, NBFCs, including housing finance companies. And the foremost and most importantly, applicable to lending transactions, all digital lending transactions. Okay, now let's look at the definition of what default loss guarantee under the RBI regulations is. It's any contractual arrangement by whatever name called. The idea is that such contractual arrangement is in the form of a guarantee which compensates a regulated entity for the losses that result due to a default in a loan portfolio up to a certain percentage of the loan portfolio. If we break it down further, the intent is very clear. Any contractual arrangement in the form of a guarantee to make good a particular loss on a portfolio, the arrangement could be explicit or implicit. This is fairly important, which then widens on how these DLG agreements can be structured. Can we go on, Krishna, to the next slide? Okay. Before we delve into further nuances, and I'm sure this will raise a lot of concerns, so feel free to reach out on the Q&A or just raise a hand. Happy to play it by ear. We thought before we delve into what's permissible, what's not, and take up specific questions regarding those, it'll be good to kind of look at what the market's been doing with these arrangements. Right? Let's begin with a loan level guarantee. Just take an example here. A lender originates a portfolio of 10 crores for customers sourced through fintech, a fintech entity. The fintech entity guarantees to cover defaults by the customers up to 5% of each loan disbursed. In this example, the guarantee is at a loan level. Only 5% of that specific loan is what is extended. Should a particular loan go bad completely, be in default, become a non-performing asset, despite the losses that are incurred or the default amount, the guarantee is only 5% of the total loan amount. And that's at a loan level. As opposed to a portfolio guarantee, which is what the RBI guidelines focus on. Now let's look at a default guarantee, which is at a portfolio level. The same scenario, a lender originates a portfolio of 10 CR for customers that are sourced by a particular fintech. The fintech guarantees to cover defaults by customers up to 5% of a loan portfolio. This further default guarantee can be structured in different manner. It could be a first loss default guarantee, which means the first losses that are incurred up to 5% of the loan portfolio would be covered. Or it could be a second loss, in which case the fintech guarantees to cover defaults by the customers up to 5% of the loan portfolio after the lender covers the first 5%. Right? So default guarantee at a portfolio level can be structured in different ways. There could be a first loss, there could be a second loss as well. Then, of course, you have the slightly more nuanced versions that came in with respect to collections and not directly linked to defaults on a particular loan portfolio. There was a collection deficiency model that the industry looked at very closely and restructured in light of the DL guidelines. And there was a collection efficiency model. Both played a role with respect to the collection services that a lending service provider enables. One was a deduction in a particular fee that's payable because of inability to collect the monies from the borrowers. And one was a structure that rewarded the collection efforts put in by a particular collection agent to recover the outstanding amounts. It was, of course, a play on the numbers, the service fee that was payable, but was structured from a contractual perspective, not directly linked to the losses. In some instances, of course, there are arrangements where collection deficiency is directly pegged to the loss on a particular loan. We will, of course, look at whether those models are permissible or not and whether they fall within the definition of default loss guarantee as prescribed under the guidelines. But these were two important models that came up. Of course, along with the collection deficiency and collection efficiency model, there were structures around a performance bonus, and there were structures, contractual arrangements around liquidated damages, where losses for inability to recover money from borrowers were considered liquidated damages and were triggered as a contractual arrangement between the servicing and collection agent and the RE.
Before we go on to analyzing this and loss guarantees, if I could just chime in here, one of the questions that I keep getting is the difference between what some commentators are calling an explicit guarantee versus an implicit guarantee, right? I would encourage you to look at DLGs and product structuring around DLGs, not divide them into explicit guarantees and implicit guarantees and say, oh, implicit is not allowed, this is allowed. The term implicit guarantee should be read back to two historical positions. One is that you should not do indirectly what you are not allowed to do directly, right? So while structuring collection deficiency models, service deficiency models, loan level guarantees, the end mathematic result of that should not be the same as a default guarantee is above 5%. So that's one clear RBI. And the second clear RBI rule is that while doing this, one should not violate the spirit of the day, the often mythically quoted spirit of the DLG guidelines, i.e., you should not exploit the RBI's use of one word or the other to squeeze in something which the regulator did not intend. So while talking about structures and possibilities, let's just keep these two things at the back of our heads. And Ankita, of course, if you disagree with me, let me know.
No, absolutely. Substance over form always. Okay, just quickly on second loss guarantee. I think when the guidelines were first introduced, there were concerns on what forms of loss guarantee does the guideline cover. The intent is very clear. There is definitely rationale why the guidelines are called default loss guarantee as opposed to first loss default guarantee, which was the reference that were made across all the previous committee reports and recommendations. The idea is to ensure that it is not restricted to one type of loss guarantee, first or second or mezzanine. It is across the entire portfolio. So irrespective of how you structure this loss guarantee, first or second, even a second loss guarantee in arrangements between an RE and an LSP would be covered within the DLG guidelines. I think that's a fairly clear position that we can be assured of that the intent is very clear with the way default loss guarantee has been defined. Krishna, let's go on to the next one. We've specifically taken up certain concepts that we thought were raising concerns. If there are any other aspects that you want us to focus on, please feel to drop in a line or just raise your hand. Now let's look at a loan level guarantee. The definition of default loss guarantee currently refers to a portfolio, a specified percentage of a loan portfolio. If we were to structure a loan level guarantee, let's take an example. A loan's been given to an individual, which is repayable in 8 installments. The first EMI is paid. However, the second and the third EMI is where there is a default. Now, if this arrangement, an LSP has guaranteed 2 EMIs in an entire loan, this structure ought not to violate the DLG guidelines because this is not a situation or a structure that the guidelines have currently envisaged. Right? In this arrangement, the guarantee is specific to a particular loan, in which case, if the entire loan goes bad, the guarantee will still be limited to 2 EMIs. And if the entire loan performs well, there will be 0 guarantee at all. This structure can be evaluated. Of course, if this structure is misused to an extent where you start giving out 100% loan level guarantees, which will then eventually mimic an entire portfolio guarantee, that would violate the spirit of the regulations. So we've had instances where there's been concerns whether can you do 100% guarantee at a loan level, right? And Mathew, let me know if you disagree, but to my mind, that would mimic exactly what the RBI is trying to stop, which is very clearly evidenced on the concerns that they've raised in the past across the different notifications and press releases. It cannot mimic exactly what they've been trying to restrain through these guidelines. So as long as a loan level guarantee is structured in a compliant manner, does not take the form of synthetic securitization, which the RBI has already raised concerns with, and is limited to certain use cases where this structure works well for LSPs and REs, this is a structure that is viable under the DL guidelines without it falling within the definition of default loss guarantee. Then let's look at the differential collection fees, right? We discussed collection deficiency and efficiencies and a performance bonus structure. There are different arrangements being followed between LSPs and REs today where until the default loss guarantee guidelines were issued, the collection efficiency matrix on the fee was linked to the losses that were incurred by the RE on the loans disbursed. If a contractual arrangement of this sort is structured in an agreement between an RE and an LSP, it would most likely fall within the parameters of an implicit guarantee. However, should this be a certain metric that is linked to the collection efficiency efforts and the collection processes that are followed by a particular RE? These could be compliance with codes. These could be certain key performance indicators that are set out in a contract. And then a particular reward or penalty that is contractually agreed upon that be deducted from the fee or be enhanced to be paid in the form of a performance bonus, provided it is not linked to the losses and do not link to performance of a portfolio, should also be a structure that will fall outside the purview of default loss guarantees. Now, quickly, let's just look at the eligible DLG providers, right? The RBI in section para 3 of the guidelines very clearly says that regulated entities can enter into default loss guarantee arrangements with lending service providers. It's very clear that these lending service providers ought to be incorporated as a company in India under the Companies Act. Simultaneously, it also highlights that it could include other regulated entities with whom they've entered into an outsourcing arrangement, an LSP arrangement for customer acquisition or for servicing a particular loan. These are the eligible providers with whom an RE can actually enter into DLG arrangements with. Now let's look at the co-lending model. And I'm sure this has raised a lot of concerns between the regulated entity. And I heard there are different stances that have been taken here. A co-lending arrangement between between two NBFCs, given that para 3 focuses and explains that DLG providers are either LSPs or REs with whom regulated entities have entered into an LSP arrangement with, there are two questions that arise. Whether co-lending between a loan originating RE and a co-lending partner would also qualify as a DLG provider. Two, should there be a co-lending arrangement between two NBFCs? Can the loan originating NBFC contribute 5% of the loan portfolio of the co-lending partner? So say if the lending arrangement between NBFC 1 and NBFC 2 is 10% and 90% of a particular loan that ought to be disbursed, can NBFC 1 guarantee 5% of the portfolio or the risk participation already undertaken by NBFC 2, which is 90% of the loan portfolio? So while NBFC 1 is only disbursing 10% of the loan disbursed amount, it will also guarantee up to 5% of the disbursements undertaken by NBFC 2.
Ankita, if I could just jump in here.
Yes, ma'am.
We have a question from Sumit. And Sumit wants to know why co-lending arrangements between NBFCs are not covered by DLG.
One of your posts provided that the circular is not applicable for co-lending arrangements between NBFCs. Yeah, so Sumit, over here, the way RBI has defined DLG providers under para 3, it talks about digital lending arrangements with respect to LSPs. So when an RE enters into an agreement with a loan service provider, the DLG provider in that instance can be an LSP. However, if an RE also enters into an arrangement with another regulated entity, where the second regulated entity is acting as a loan service provider, even in that instance, the LSP entity, the regulated entity that acts as an LSP, can be a DLG provider. However, we are envisaging a situation where there are two regulated entities. They may not, one regulated entity may not specifically source borrowers for both partners, right? It is shared lending for all purposes. So if an RE decides to onboard a customer and then decides to co-lend with a second RE, that would not amount to an LSP arrangement between the existing REs. Unless, of course, there is an arrangement where there are two REs and an existing LSP, in which case this extension would also apply. However, if you purely look at two REs where one RE is not acting as a lending service provider for the other RE, it has onboarded a particular borrower and decided to co-lend with a particular RE, and the disbursement ratio between the two, that ought not to fall within this definition.
So to summarize very quickly, given that there is already a well-established co-lending framework by the RBI, which is very clear between two REs, as long as the co-lending is not disguised digital lending, the digital lending guidelines will not apply. Does that, Ankita, quickly summarize your position as well?
Yes, ma'am.
Right. So again, we'll go back to what can't be done indirectly, directly should not be done indirectly. But as long as it's actually a pure co-lending risk sharing model, you're out of the purview of these regulations. I hope that answered your question, Sumit. If not, why don't you come on live and we can have a chat? Well, I'm guessing that answered his question. Let's go on.
Okay, let's go on. Okay, now let's look at structuring DLG arrangements. It's very clear that the default loss guarantee provided by the DLG provider is subject to a cap of 5% of the loan portfolio. There have, of course, been different interpretations to how you determine loan portfolio, because in certain instances, the RBI has used the term underlying loan portfolio, and there are concerns on whether this would be the outstanding amount or whether this would be the disbursed loan portfolio. In our opinion, the intent of the regulator is very clear. It ought to be 5% of the disbursed amount. If you were to consider the outstanding amount, given that you will have to keep factoring in repayments that are constantly taking place, the 5% would keep varying, and there will be a larger cover as opposed to 5% of the disbursed amount. We suspect here, while the regulations do not very clearly specify this, and I suspect there ought to be FAQs that will be issued in this regard, the intent is that it's 5% of the disbursed amount. right? Now let's just look at DLG, the form of DLG, cash deposits. Unlike the different forms that were used by fintechs and regulated entities, there were intercorporate loans. There were other structures that were put in place. The RBI guidelines very specifically lay out three forms: a cash deposit, which could be in the nature of a security deposit for performance, a fixed deposit with a lien in favor of the regulated entity, or a bank guarantee in favor of the regulated entity. These are the three forms in which the guarantee can be provided under the existing guidelines as of today. Krisha, can we move on? Sorry, are there more questions? I'm seeing some pop-ups, but I'm unable to. Yes.
Since you're clearly the target. So I think Soumya and Sumit both have asked questions in relation to the whole RE as an LSP concept, right? And I think there's a little bit of lack of confusion. I think Soumya's question is, what about tech-led REs, meaning fintechs who've got an NBFC license, I'm guessing, which have a fintech entity as part of their corporate org structure. So let's say parent is a fintech. They've got so much money from all these VCs who love throwing money, or love throwing money at all these fintechs because you made an attractive pitch deck, right? And they could not see through that, but they started an NBFC, and let's see whether that relationship can be structured through a co-lending model. And Soumya, I think the answer is very, very clear. If it's actually a co-lending model and not a LSP model, it's possible, right? So we have clients who've got large NBFCs who do the business of NBFC, while some of them operate as a tech entity, which is a customer sourcing entity, yada, all of that. We don't think that the RBI intends to attack that, as long as the intent of the parties is actually co-lending and it doesn't look like an LSP service, right? And it's very easy to make out, right? So that's the broad answer, but be very, very careful with the language of the arrangement, the co-lending arrangement. It shouldn't smell like a LSP arrangement, and it should not the risk and allocation between the parties should not look like a risk allocation between a lending service provider and an RE. It should look like a risk allocation between two regulated entities. So Sumit, to your question, can a co-lender never be called an LSP? It can, in which case the digital lending guidelines would apply, right? So if a co-lender is an LSP and is acting in that capacity, then the DLG guidelines would apply, right? So those are the broad questions around that. Shashwat has got a question around, which you and I have spent a lot of time debating about, this whole disbursed amount plus interest amount, or just disbursed loan. Ankita, go ahead. I've talked too much.
So Shashwat, of course, there's no clarity yet, right? But as of now, I would presume any wider interpretation of how to arrive at this number would be tricky. Just by a plain reading of the regulation, to my mind, it ought to be just the disbursed amount. If we venture into interest, then we are venturing into whether it's outstanding, what other dues would fall within their entire portfolio amount, which will make the calculations murkier and will then end up allowing for a guarantee over 5%.
So this is one of the 2 or 3 issues which we will be writing to the RBI on. I think there are 2-3 issues which still require clarity. The other of that question that I'm sure will come up about that FAQ number 4, that whole credit card loan product nonsense that was just not required. We will be writing the RBI on that, and this and a couple of other issues. So if you do think that there are things you'd like to ask the RBI, but you don't want to be in front of it and would like to ask us, if you can convince us that it's a legitimate question, we'd be happy to bear the brunt of approaching the RBI for you. They've usually been very responsive to most of the things that we've asked them till date.
Just quickly addressing Sumit's follow-up question. So co-lender can never be called an LSP. If yes, co-lender can provide FLDG, right? So if a co-lender is also acting as an LSP, it will fall within the DLG guidelines. If the co-lender is not acting as an LSP, typically it is the ratio of the disbursements. Of course, between two NBFCs, there is no formal regulation by the RBI that dictates how co-lending ought to be done. It is with banks and NBFCs typically. With NBFCs, they are governed by their internal board policies. The DLG guidelines as of today do not cover that situation. So while it is standard to limit the risk participation to the disbursed amounts by the respective NBFCs, whether NBFCs will now consider co-lending arrangements where they can top up and give an additional default loss guarantee is something that we'll have to evaluate and see how REs undertake. But of course, not restricted by the DLG.
Ankita, I think Soumya wants to speak. Soumya, can you unmute yourself and say hi?
Can we allow speaking rights?
Okay, so while we're waiting for Soumya and Sumit to jump on, Ankita, there's a question from Swaraj who asks whether DLG cover of 5% works on a diminishing basis, meaning if 1% has been invoked out of 5%, can the LSP reinstate it? So basically the question of whether it's outstanding or not. Do you want to take that?
Yeah, so I would take a conservative view here. I don't think we can reinstate it back to 5%. And let's take an example. Say an LSP is agreed with an RE. An RE is agreed that depending upon the kind of borrowers that a particular LSP sources, they are willing to have a portfolio up to 50 CR with a particular LSP, provided, of course, it meets the internal checks and balances, credit decisioning, all of that. Now, for this 50 CR portfolio, if we've agreed at a 5% default loss guarantee, and that entire default loss guarantee is today maintained with the RE as a fixed deposit, that 5% can only be triggered in a pro rata manner. So if within 1 month, only 10 crores been disbursed, then it's 5% of that 10 crores. In the second month, if it's 20 CR, then it's 5% of the 20 CR. So even though I'm maintaining the entire 5% of 50 CR from a portfolio perspective, the right to trigger it will only be linked to the actually disbursed amount, right? The idea would be to refrain from any calculations which allow a replenishing model where you will in effect have a guarantee of more than 5%. I hope that addresses your concerns.
Have we figured out how to give speaking rights yet?
Hi, Mathew. Yes, I'll just give speaking rights.
Yeah, please do. I think two people. One is Soumya Nagpal and the other is Sumit. I think Sumit agrees with us on the reinstating of the cap.
Yes, I've given speaking access to both of them.
Soumya, do you want to go? Okay, so while Soumya and Sumit figure out, yeah, please go ahead.
So my question is we agreed, we understand right now that, my co-lender can be called as LSP because technically when we see digital lending is happening on a platform, like the structure that you told that there is a fintech or holding company, then there is a NBFC, then there are partner NBFCs to that structure. So in that case, 90% of the work maybe, from sourcing and all other activities are largely done by the co-lender. So in that case, my co-lender, we understand right now that my co-lender can be called as LSP. And as per this circular, the LSP can provide the FLDG. So in this case, technically, it should mean that a co-lender can provide FLDG to another co-lender, right? Because there is an express
Up to
word of
5%.
up to 5%.
Yeah.
Okay, okay, okay.
Correct. But also, let's also not forget, just because your NBFC is owned by a tech entity, it
Mm-hmm.
does not mean that automatically it's an LSP relationship. The NBFC might get into a pure co-lending arrangement. The risk allocation might be identical to a co-lending arrangement, in which case the DLG guidelines do not apply.
No, but then LSP is said when an entity performs one or more functions. So if the sourcing is being decided, technically there will be the co-lender who would decide that the loan which has been or the borrower which has applied will go to which co-lender, because they would have 10 odd partners, right? So technically my co-lender is also doing the sourcing function, and also along with the other function like customer servicing. They will resolve the customer service queries. They will do all those activities which are required to be done by a co-lender, which are
Okay.
required to be done by a lender.
Yeah. So
So,
while
mm,
structuring this relationship, Sumit, is a longer conversation.
mm,
Here's what
sorry.
I would think the approach should be, right?
Mm,
You put all the services provided in one basket, you put how the risk allocation happens in another basket, right? Neither
mm,
one should be determinative,
mm,
but if when you look at both of these, risk allocation and services provided, if it looks like a traditional co-lending arrangement, right, then in our view it would be a co-lending model and DLG guidelines would not apply. If it looks more like a DLG guideline, like a digital lending arrangement, an LSP arrangement, then the DLG guidelines would apply, right? I don't think we should say just because I'm doing sourcing, I'm automatically an LSP,
And
right? Because
just to add to what Mathew said, if we go back to the digital lending guidelines, the definition of an LSP is an LSP acting as a lending service provider subject to a contractual arrangement with an RE. So if there are two lending parties where one lender is acting as a sourcing agent and an LSP for another lender, there will be a back-to-back arrangement. Unless we're talking about a tripartite arrangement where there is one lender, there is a second lender which has its own tech entity, which has a DLA that sources the borrowers, and then the co-lending is done by the two co-lending partners at the back end. In those instances, the fintech can be the DLG provider. But we are envisaging a situation where there are only two lending partners. If there are two NBFCs that are lending, and the first NBFC has a particular borrower who's interested in applying for a loan, and that NBFC has decided to co-lend and undertake shared lending with another lending partner, that is not covered. So it actually depends upon how the arrangement is, what action you're actually undertaking on behalf of your co-lending partner, or is it an action that's undertaken in isolation as your NBFC business without doing it on behalf of the co-lending partner.
Okay. Thank you so much for the clarity.
okay, let's move on, Ankita. Otherwise we'll get stuck on this slide. We'll come back to the questions.
Okay, so just quick compliance requirements. Of course, some are mandated under the guidelines very clearly. Some are good to have. Let's quickly run through those. So regulated entities are required to put in place a board-approved policy for entering into DLG agreements. These should be very clearly thought out. How will they evaluate the eligibility criteria for a DLG provider? Of course, the idea that the RBI wants to ensure is that the fintechs have enough liquidity and capital adequacy to be able to fulfill the guarantee that they are giving. So eligibility criteria, each RE needs to evaluate at its own end and have a board-approved policy that determines this. The nature and extent of the DLG cover allowed, the process for monitoring and reviewing the DLG arrangement. So how you evaluate the portfolio, as and when the portfolio grows, do you keep topping it up with additional guarantee up to 5% of the increased portfolio? So those are aspects that need to be evaluated, and fees that will be paid to the DLG provider. Additionally, aspects that can be considered as well are manner and timeline on how you're going to do a due diligence on DLG provider? Would the RE seek for financial records, provisional balance sheets, any sort of additional documents that may be necessary for an RE to conclusively be comfortable with the DLG cover that is being provided? Factors that you will consider for due diligence. Put in processes and standards as a part of your policy, which will cover the contractual arrangements, at least the broad contours of what the contractual arrangement ought to cover. How will you account for this? And need disclosures that are required. Can we go to the next slide, Risha? Now, compliance requirements. As a part of the due diligence exercise, a regulated entity must ensure the following aspects. So you basically need a declaration certified by the statutory auditor of the DLG provider, which contains the following aspects: the aggregate DLG amount outstanding, the number of REs, the respective number of portfolios against which the DLG has been provided. So if a particular DLG provider has arrangements with 15 regulated entities, you would want to have visibility on the portfolios there and what would 5% of those portfolios constitute. Past default rates on similar portfolios, recognition of NPA and capital computation. So recognition of individual loan assets in the portfolio as NPA and consequent provisioning for the same. The amount of DLG that's been invoked cannot be set off against the underlying individual loans. The RBI guidelines mandate that very clearly. You must also disclose the total number of portfolios and respective amount of each portfolio on which DLG has been availed on your website. So these are compliance requirements that the RBI has mandated. Can we go to the next slide? Let's just look at the contractual arrangements, right? The guidelines specify certain aspects that must definitely be detailed in a written agreement. So the form of DLG, the extent of DLG cover, how it's going to be maintained, the timeline for invoking, the amount of the portfolio covered, and the quantum of DLG, right? Additional aspects that we may have to consider given the revised guidelines to make sure there is no ambiguity in the agreement is to detail out these aspects contractually. What are the triggers? What are the limitations on invoking it? The frequency in which the cover is going to be invoked and the payouts. Say if it's in the form of a bank guarantee, how would it function? If it's an FD with a lien, it's relatively simpler because you just trigger the lien that is already there. How do you cover for enhanced loss guarantee amount that ought to be maintained over and above as the portfolio grows? So those are aspects that need to go in as well. The utilization of the DLG cover, corrective actions in case the DLG cover is not paid up. Say a bank guarantee cannot be invoked. How do you ensure those in situations? So those are additional measures that need to be considered in an arrangement of this sort. I think all the contractual arrangements that fintechs today have with regulated entities will have to be revamped in light of these new guidelines with more nuanced focus on how the loss guarantee clauses ought to be structured, detailing our different mechanisms.
Okay, time to throw it open for discussion. Are there any questions? Does anyone want to chat? Is there anything else you'd like us to go into? Anything? And Ankita, I think this is the first time and perfectly done. Also probably because I wasn't speaking too much. But this is the first time we've actually finished on time. Usually we are 15 minutes late.
Mathew, there's a quick question from Sudarshan. I'm not sure if I've understood this. Sudarshan.
Let's get Sudarshan on the...
Yes, Mathew, doing it.
Sudarshan, would you...
Is Sudarshan still around?
Sumit, we'll have sessions. We have 20 other sessions coming up. Go on.
Okay, perfect. So I think my question to whether we can offer as an MSP, can we get into agreements where some part of this DFG is what they say unfunded? We need to make 3 to 5%. Okay, that 5% as a cash
Ankita, can
collateral
you
through
hear
one of the 3
Sudarshan?
allowed means.
No, Mathew, voice is breaking for me.
Sudarshan, I'm sorry, your voice is, maybe you're in a bad network zone.
Sorry, is it okay now?
Well, no offense, but if you know who R2D2 is, you speak like R2D2 now. But anyway, do you want to try again?
Yeah. I mean, if it's okay, I'll try. Else, as well.
Sorry, Sudarshan, I apologize, but it's just not audible. Perhaps we'll come back to you once we're in a better place. Ankita, Ronak has a question on collection efficiency model and when it would be construed as implicit guarantee. Why don't you give him your perspective and then I'll jump in.
Sure. So, Ronak, the collection efficiency model, if it is structured in a manner where the efficiency is being linked to the performance of the portfolio, where we are pegging the efficiency percentage or a performance bonus or an incentive for collections based on how the loans performed at a portfolio level, it's more likely to fall within an implicit guarantee structure. However, because the RBI guidelines focus on there being a guarantee to make good a loss or a default in this instance, if we were to structure the collection efficiency model as a contractual arrangement, which is more specific to a particular fee that's paid for collection and collection parameters and collection efforts being undertaken by a collection agent, and de-link it from performance of the portfolio, it ought to fall outside that bucket. Right. So there is a very fine line on how to structure this to make sure it is not an implicit guarantee and is a contractual arrangement linked to collections and not the performance of the portfolio. Mathew, do you want
Right.
to?
So two guardrails, I think. Yeah, two guardrails I think you should be wary of when structuring collection efficiency. One is the net result of the collection efficiency should not be very close to a default guarantee, either in spirit, formula, all of that, right? So it has to be actually a collection efficiency linked process. The second, far more importantly, the collection efficiency should reward collection and expenses and attempts at collection, not be linked to, again tying to the same point, not be linked to how much default there has been in a loan portfolio, right? It's a thin line you'll have to walk. It's definitely permissible. As the RBI come out with certain collection efficiencies, we'll know in what circumstances the RBI deems some of these practices to be stepping over. But it's a line at this point that you and your lawyers and your regulators would have to sit and jointly draw in substance. So looking at how the entire portfolio works, but two, and equally importantly, in how you draft that language into your contract. Right. So both of those are important from an RBI perspective, because as of now, we're very clear. The RBI's past actions have been very clear. Trip up either on substance or on form, you would have, RBI would deem you to have tripped up. And we can of course go into details on what this means, but there are organizations at this point who've structured it, fairly risk-averse organizations who've structured it in a manner that they feel on receiving legal advice is something that the RBI would not offend, or at least the deadlines will not be offended. Help?
Yeah.
My network patchy, Ankita?
Yes, Mathew. I think just now, I think the last 30 seconds, I think it's been patchy. I think Swaraj has a similar.
So I'm also. So I said I'm also R2D2.
I think Swaraj, I hope Mathew's response addressed your concerns as well. Right? The way the RBI defines implicit guarantees within the default loss guarantee structure is a similar nature of guarantee, which is linked to performance of the loan portfolio, which is what it's trying to cover within the default loss guarantee structures. As long as it is delinked from that, it is structured in isolation with collection parameters, we should be able to structure it in a compliant manner.
Ankita, Meenal has a question on recognition of NPAs.
Yeah,
Meenal, that's a longer. Yeah, go on, Ankita.
I think Soumya also has the same question.
Yeah, I think that's a longer chat. Perhaps we'll do a session on recognition of NPAs. But that's something I think if we go into, it'll be a larger debate and it'll remaining time. So Meenal and Soumya, if you could indulge us and we could skip that. Unless Ankita, you want to express a quick summary.
Just a quick summary, Soumya and Meenal, we'll have to, of course, go back to the prudential norms on how this ought to be, how NPAs ought to be accounted for as per the prudential guidelines. All that the RBI highlights in the DLG guidelines is that once you invoke the default loss guarantee, you can't set it off against the defaulted amount. So say there was a default equivalent to 10,000 rupees, and the FLDG against that was invoked, it can't be set off against the defaulted amount. The asset is still a non-performing asset. And that needs to be continued to be treated the way prudential guidelines prescribe. That's just a quick summary. Of course, we can have a more detailed discussion on how this will practically pan out.
Okay, so Ankita, I think the only remaining questions are from Sudarshan and Sumit. And I must thank them for breaking the monotony of us speaking. Do you want to take Sudarshan's first?
Okay, let me just go over the question once.
We can go with question now.
So, yeah, Sudarshan, if I've understood your question right, I suspect you're saying that an LSP is not allowed to split the 5% in 2 or 3 different forms, and that the entire 5% ought to be in one particular form, either a cash collateral or an FD or a bank guarantee. Is my understanding correct?
No, that's not it. I'm actually trying to check if some of the say 2%, then one of the 3 accept.
Mathew, I can't hear Sudarshan.
Yeah, neither can I. Sudarshan, you know my number. So I think you should call one of us after this. Meenal has a follow-up question, which I think is again something we've discussed ad nauseum, as lawyers say, is can FL taken for non-digital lending loans? Do you want to go first, Ankita, and then I can go?
Sure. So, Meenal, the DLG guidelines and the 5% threshold and the cap is, of course, restricted to digital lending, and specifically under the guidelines, the digital lending guidelines and the structure that is envisaged with LSPs and REs. The question then arises, how do you structure the loans that are physically enabled? For those structures, we'll have to go back and evaluate whether the risk participation is compliant with the securitization regs, is compliant with the transfer of loan exposure regulations. And if it's by a bank, then guarantees and guarantees master circular and co-acceptances. So those are 3 frameworks that we'll have to evaluate. Any contractual arrangement with risk participation will have to be evaluated along those 3 circulars very, very carefully to make sure none of those are being violated. Mathew?
Yeah, no, that makes sense. Yeah, exactly. So there are normal rules that are incident on regulated entities in respect of taking guarantees. As long as you comply with those, non-digital loans can take some guarantee. Some guarantee can be provided for non-digital loans. I have a question that's brilliant, and it goes back to my days when I did my first, I'm trying to put this politely, NBFC as a service agreement, right? The idea, anonymous attendee, is that an NBFC is given a license because the RBI has done X amount of due diligence and has figured out that an NBFC has the capacity and the skill sets and the risk identification method to actually do lending. If that NBFC was to abdicate its role and responsibility to a fintech and allow the fintech to call the shots on who it lends to, that's what most of us in this industry call NBFC as a service, or absolute rubbish also, and what the RBI calls rent in NBFC, right? That's not permissible. That was never permissible. If anyone thinks that was permissible at some stage, then you don't know the history of financial services regulation in India. All those who've been doing it from the first day have been doing indirectly what was not allowed to be done directly. And I remember I was doing my first RBI advice in 2003, and the first thing that came to me from a regulatory consultant was, please don't try to do indirectly what's expressly prohibited, right? That's what, I hope that helps, but that's not a gray area. I think an NBFC is clear, black and white, not permissible. I think with that, those are all the questions there are. There are still 50 people, which means someone wants to ask questions. But if there are no questions, bang on time, if it's over time limit, we'll then close this webinar. But as always, you know our email IDs, you know our phone numbers. If you do have further questions around this, in fact, over the last 2 to 3 weeks, our digital lending team has been doing primarily structured sessions of this. So if you do have questions, if you want to sit with us and think through products, any way that we can. All right. With that, thanks everyone. Bye.
Thank you. Thanks, everyone. And Sudarshan, if you're still around, we can probably connect offline to specifically address your concerns. Thank you. Thanks, everyone.